Good evening. I thought I'd give you another update this week. And thank you, Henry, for asking about the bond market, because that's something I've not touched on, but that is what the focus of this week is going to be. So let me just share my screen here, and I will bring this up. Yeah, so today's focus is going to be more about the bond market. So here we go. Yeah, so just a very quick overview. A bond is basically an IOU. Unlike a share where you're sharing in the profits, a bond is simply an IOU. You lend either a company or a government money, and they will give you a fixed rate of interest for that period of time that you lend them the money for. So it's to them. So you get an interest rate, and it's a limited time. You typically lend the money to the government. So here's an example of one, Aviva PLC. That's if you lend them money at the moment, they'll give you 6.125% in return for that. But because interest rates are so low at the moment, the price you have to pay for £100 worth of those bonds is £113. So it's a bit of a balance between paying for the price of the bond, because you only if you hold that bond to maturity at 2036, you will have a loss because you only get £100 back. Every bond is priced at £100 when it's opened, and then depending on what interest rates are doing and the time to maturity are doing, that's what affects the prices as well as the underlying company or government. So that's an example of a bond. So different to a share. Share, you're sharing the profits. A bond, simple, straightforward IOU type contract. So the three things you have to understand about bond. The bond prices is affected by three things: the underlying company or government that you lent the money to, the amount of the coupon, and the time to maturity. And the coupon is simply the interest rate. So what happens is as prices of the bonds go up, the yield goes down. So very simply, if you buy a bond when it first opens, it's £100 and it's got a 4% yield. If the price of that bond goes up because maybe interest rates are falling, let's say the price goes up to 104 for that £100 worth of bond, then the yield goes down. So you're only actually getting 3.84 as opposed to your 4% because you bought it at 104. So it's quite an important relationship to understand, but it's quite complex. It took me years to get my head around it, but so don't worry if this my simple explanation doesn't give you the answers you need or the understanding you need. It may take a while to digest. So here's some slides just looking at the bond, what's happened to the bond market and the equity market over time. So what we've got here, we've got S&P 500 and the blue line in bonds. It's showing that what we've had, bonds and equities have performed very well over the last 20, 30 years, which is unusual. It's an unusual set of circumstances, economic circumstances that have brought that. So that might be something of concern, that the future will not look like that. Absolutely. A gilt is basically a government bond. So if we look at how much a government bond in the UK priced, it would give you, if you bought a government bond in 2007, you were basically getting an annual return of 5.3%. That was the income that they would pay you for lending money to the government. Now, if you did that today, you would get 0.5%, and actually probably less, because this was a few months old. So that's pretty interesting. What that means is that you're not really getting much of a return from government bonds. You're sort of getting the safety, because obviously governments can raise money, but you're not getting much of a return from them. What's happened into the bond market over that time, we've seen a huge number of bonds that have got negative yields. So you buy a bond, you're going to have to take a loss by the time if you held it to redemption. So there's a huge pool of negative yielding bonds out there, which is a sign of unhealth, an unhealthy sign for an economy and the bond market. And because bonds have been yielding so little and government bonds have yielded so little, what that's meant is investors have moved away from bonds into other investments to try and find a return, a decent return. And that is one argument that the equity markets have sort of overperformed over the last 10 or 20 years. I don't quite fully, I believe this has happened, but I don't feel that equity markets have dramatically outperformed because it's a factor, but it's interesting that it's basically forced people to take risk to get returns in the hunt for higher returns. The bond market has increased dramatically. This slide's, yes, this slide shows here that since 1998, the actual overall amount of bonds available is massive. So governments and companies have taken on more and more debt. And I think that is a sign of a red flag. And I think this is going to be a headwind going forward for economies as they recover. There's just so much debt out there. But this, you can see this darker green patch, it shows the rise of triple B bonds, which is basically the not very high quality bonds. So you've got basically different rankings of bonds, AAA, AA, single A, and triple B. And slightly disconcertingly, triple B bonds are sort of referred to as junk bonds. So there's been a huge increase in those junk bonds. That's basically companies borrowing money. Just and this. So we're seeing that what a lot of the US companies are doing with the borrowing that they're doing is they're buying back shares in their company. Now, to me, this is a pretty nasty thing to do, because what you're seeing is instead of borrowing money to maybe buy a new factory or build or expand into a new country and expand your company, what some CEOs are doing is taking advantage of low debt and then buying back their shares, the company shares, which has got a squeeze effect, which means the share price goes up because they've bought back, there's less shares available. I think it's a very cynical thing to do. It's not particularly healthy. What it means is it's sort of CEOs, the short-termism of CEOs who are basically on a package which will probably include share options and which will pay out more if the share price has done well. And it's not. I don't think it's a good thing at all. You'll probably agree, but it's sort of short. It's almost like politics, where you're basically putting very short-term policies in to placate the electorate, as opposed to looking really long-term at running your company for the next 100 years. So you're running your company for the next 100 years. You'll try and keep debt to a minimum, and if you are taking on debt, you'll do into big expansion things, which are going to have positive for profitability, as opposed to profitability for purely the shareholders. And quite short term. So yeah, I think that's a concern to look at that chart there. What we've seen is with low inflation and low rates have allowed equities to do well and bonds to do well. So there's been really quite an unusual set of circumstances that we've seen both equities and bonds both performing well. Typically, you wouldn't expect that as you go back. If you look back on that chart, you see when bonds have done well, equities have done poorly, and back in the 80s there. And if you look back in the very beginning of the chart, you're seeing sort of equities are relatively flat, but bond prices are doing well. So that's that. Yeah. This week there's been a few announcements, and this, to me, this is quite a big red flag for the economy in general and the bond market. So quantitative easing is when governments buy back bonds to reduce the cost of borrowing to stimulate the economy. So that's exactly what happened in 2008. You can see this chart here. 2008, quantitative easing for the first time. They did 3 or 4 rounds of it, and the good thing about that is it keeps borrowing costs low. But the bad thing about it is the governments get this huge debt pile. And rather concerned looking at this chart. So we're now, with the coronavirus, they announced more QE, having not really paid off back the previous QE. So yeah, to me that sort of says, if you imagine the economy was a hospital patient, it was on the operating theatre back in 2008, and it was basically flatlining. So they pumped in quantitative easing, interest rates lower, try and stimulate the economy, and that worked. We got the economy back. But what has happened is we haven't weaned the economy off the drugs, so it's still in intensive care, if you like, and not healthy on its own. And by doing interest rates very low, we're back to zero, and another round of quantitative easing, it's a quite a big red flag that the economies are not particularly healthy. Yeah. This week we've seen a few announcements. Remove my face there. You'll see that. That's a picture. So Ford have had their bond status reduced. So bond where Ford, as you imagine, a big high quality company, you think are fairly safe bet for your money if you're lending money to Ford. They were AAA. They've been downgraded this week to junk status, which is BBB. So that's again a concern. So the cost for Ford to borrow money in the future is going to be a lot higher, and that's just the start of this. So Deutsche Bank are saying that 90 billion worth of debt fell into junk status last week, and they expect that overall 200 billion of corporate debt will fall into that status throughout the next few months. Again, a concern for the economy. This is going to be a real headwind as we go forward, getting out of this, getting the economy stimulated again on the back of the coronavirus situation. Yeah. Now, as we've seen, I've been mentioning the monetary policy, the quantitative easing, and interest rates very low, and we have now had fiscal spending coming through. And I think it's crystal clear that going forward, there's going to be a huge amount of infrastructure spending, further tax cuts. So yeah, it's going to be very different. So we're going to have monetary and fiscal stimulus going forward on the back of this, and that's going to have different effects on the stock market, as we've seen over the last few years. Yeah, so my conclusion about this is the bond market is a very good indicator of the overall health of the economy. The huge amount of debts that I've tried to illustrate there will be a big headwind for Western economies, and potentially that's going to reduce equity and bond returns over the next 10, 20 years. It could take a long time for us to normalise the markets, to sort of get them out of the intensive care state and back to a sort of normal state. So going forward, asset allocation is going to be absolutely crucial in your portfolios. So looking to areas maybe non-Western economies with areas like Japan, where debt's much lower, companies are a much healthier state, and that's going to be key. Also, moving that bond exposure from regular bonds to more index-linked bonds, because this effect could be very inflationary. So I'll be keeping my eye on the portfolio managers, making sure that is what they're doing, and that's what your portfolios are doing to reflect the current strange economic conditions. Yeah, so that's it. A bit of a whistle-stop tour of the bond market. Happy to answer any questions if you have any, but if not, thank you, and we'll see you soon.